Hello, Garrett. Welcome to the show, Options Brew TV. We have Garrett DeSimone, PhD, I might add, and we're going to talk a little bit about that. We have to, right? So welcome to the show.
Thanks for having me, Lex. Happy to be here.
Good, good. Yeah. So we've been chatting offline a little bit. Safe to say you're an options implied volatility expert. Can I say that?
I know a little something. I know a little something, and I'm, here to share that little something.
Okay. All right. And so we were talking again offline. You said that you did not actually trade on the trading floor, or you really weren't involved in the trading, space per se, right? And I think you said you're more of an academic, which I love because I'm not more of an academic. So I'm jealous is what I'm saying.
Yeah. So my background is 4 years ago, I graduated from Delaware with my PhD in financial economics, and I landed at this firm, OptionMetrics, and we specialize in providing high quality options data and analytics to major institutions.
Okay.
So while we don't trade, our focus is on the producing quality models and implied volatilities, Greeks, and other analytics, hedge funds and major financial institutions can use.
Okay. So your business, then your model is more toward that institutional brand. It wouldn't necessarily yet be to the true retail trading, although I know I'm twisting your arm on that one. That you get this kind of data into the hands of, I think, the retail folks who would love this thing, assuming it can be cost effective for them, right?
Yeah, and I think it's a topic we get a lot of questions about, and we're slowly starting to broach that and develop looking at some tools that would be helpful for more the retail side. And I think our ultimate goal at OptionMetrics is to be able to provide a product to retail customers that they can that is some of the institution and major players are using in the space. So that would be fantastic if we're able to do that.
Right. And what are you seeing typically from the institutions who are using your product? Are they using it to back test strategies that they might do in their portfolios? Is that a typical use case, or is there something else I'm missing?
So we have a lot of use cases across the board.
Sure.
So about 2/3 of our customers are institutions, and the other third is academics, and which are comprised of universities and some regulators, some U.S. regulators.
Mm-hmm.
But from the institutional side, there's a wide range of applications for our data. One of them involves risk metrics. So they'll look at shortfall, kind of VAR using implied calculations.
Mm-hmm.
And then we have the set that is running various option related and volatility strategies. And then there is another subset of market makers which are looking to which utilize our volatility surfaces and trade off the surface. So it really depends on what the objective of the firm is, but we have a lot of use cases.
Right. And you mentioned the educational space, right? Is one of your places you like to get your product? Is that right?
Yeah, absolutely. So academics, they make up about 1/3 of our business, but they're important to us because they provide the backbone of options and volatility research, and that's where I got my start. So it's close to my heart.
Good, awesome. All right, great. So you're going to share some slides with us. I think we're going to talk about a few things.
Yeah, absolutely.
Okay. Let's do it. And I think if you need to unshare to get to the new slides, that's fine too. No biggie. Let me just also add, if you have a question, there's a little Q&A button down at the bottom. Just fired it, and I see we had a couple, and I think Tim's taking care of those for now. I'll shoot out a poll in a little bit, just a simple poll from our side along the way. And otherwise, let's have at it. Garrett, go to it.
One of the first graphs you sort of look at when you get involved in options, at least from the academic space. Mm-hmm. And it illustrates an important concept that, kind of really, really changed my view of what options and volatility mean in terms of buying and selling, premium. Mm-hmm. And this is a graph of the SPX implied volatility and realized volatility. And it's annualized, and we've got it going back from 2015 to about today. Okay. And what it shows us here is if we look at the 30-day SPX implied volatility in the red line versus the 30-day SPX realized vol. So the implied volatility is pulled from, let's say, at the money options. It gives us a measure of what the option market expect volatility will be in the next 30 days. Mm-hmm. if we compare that to the realized volatility, we see that over the last 15 years, SPX implied volatility is systematically higher than realized volatility. And this is a term we call the variance risk premium.
Realized volatility, sometimes in the market making world, at least the world I come from, would we refer this to historical volatility of the underlying? Is that similar, or am I missing it? The realized, so that's the actual realized of the product itself. Thing. Okay, good.
Yeah, same flavor. Yep.
Okay, and then your implied here is the red line, and what you said is that you've discovered that over this time period, at least, that implied is typically higher than what's actually going on in the marketplace relative to SPX. Is that right?
Absolutely, and I don't want to make it seem like I discovered this. This has been around.
I understand.
This has been around for a long time. Yeah.
Yeah, because what's interesting is that we always found that to be true in the equity option side as well. Now, there are variances, right? That implied vol could be just smashed relative to actual, but that's a good advantage for a trader. But we tend to find the same thing in many equities as well. So I just want to make sure I understood that the right way. I appreciate that. Go ahead.
Yeah, absolutely. Yeah. So, to lead on to that point, this graph tells us that a majority of the time, if you look at the implied volatility, is essentially overpricing relative to what realized volatility is actually going to be over that 30-day time span. And that's what we call the variance risk premium. So what this means for buying options typically is if you're long put options or even call options too, you're essentially overpaying this variance risk premium every single month. Let's say you're buying monthly calls. Mm-hmm. You're paying this premium in order to basically bet on volatility. And an analogy I like to commonly use is buying options is a lot like buying, car insurance or home insurance, right? So typically when you buy car or home insurance, you don't see any return on that, mm-hmm. right? But what happens is when there's a devastating event like a car accident, a hurricane or something, the option experiences, or in this case, your premium or policy experiences a major payoff. And that's the way options contracts are structured. Mm-hmm. So if you're, let's say, an example, you're long put options most of the time, you can think of yourself as being long insurance. So you wouldn't expect to win that every month. Mm-hmm. You would, on average, you're actually going to lose that. And that's you can think of, you're paying the insurer. So if you're an option buyer, you're buying insurance. If you're an option seller, you're actually selling insurance on these equities.
Sure, that's a great point. So I would say this about the professional side of the trading business, okay, which is where I came from. We were probably predominantly premium sellers. So meaning that we would sell this risk, right? Now, we would generally make money on a regular basis doing that, assuming we could manage all the other risk of the portfolio. But there would come that off-flyer event where we'd have something binary happen, and all of a sudden, we're running for the hills and trying to cover our situation, much like an insurance company does, right? When they have a claim or they have a hurricane on, that they're insuring all the houses, when a hurricane hits, the volatility just went up for them and they're going to have to start paying out. It's kind of similar to something like that, right?
Yeah, absolutely. And, to add with that, it is very difficult to make money buying options. Mm-hmm. It's very, very hard. And, we kind of to toss in some current events here. If we've looked at, big tech names over the last 6 months, not so much recently, but buying call options was extremely profitable on those names, from last summer to about, a month ago. And that's an anomaly in terms of what you'd expect out of the return of buying, out of the money calls for single name stocks. It's really an anomaly over this period. So, I would not expect that to last. And as we're seeing in, with the yield curve steepening, tech returns haven't been that great. So,
mm-hmm. Mm-hmm. Yeah, that's a good point. So these two, I'm looking at your graph and I'm like, wow, what happened here? And I look down at the bottom. I'm like, oh my God, what is this? So I'm assuming this is the 2008 crisis, right? And here's COVID. Is that correct?
Yeah, that's correct. So though, we mentioned and we talked about the hurricane part of the insurance, and those are the hurricanes, right? So in those instances, let's say you happen to be lucky enough to be long, SPX puts before Lehman crashed, right?
Mhm.
You would have made out pretty well because realized volatility exceeded the implied level. So the option market had not correctly priced the Lehman crash, and the same thing with the coronavirus pandemic. But if you think about it this way, and we look at the entire history of it, you would have taken losses most months and made a huge sum if you were lucky enough to be in those long option strategies right before those incidents happen.
Right.
And there's a lot of research showing that unless your timing's very good regarding entering these positions before major events like this, it's still very hard to take a profit away from these trades.
Well, yeah, and the other problem is my crystal ball isn't so good anymore. So right? I mean, I love this part right here, and I love this part right here, starting to buy my options play. But golly, you're right. If you look at this, most of the time, you're a massive winner on the sell side of options. Now, one of the real hurdles with the retail side is it's not as easy for retail customers to sell options without doing it as a spread, right?
Right.
So you can sell put credit spreads and call credit spreads, and that's a nice way to take advantage of implied volatility and volatility in general, is to being able to keep those, what I call units, neutral, right? Meaning you don't have any exposed short units. And I know that a lot of people use that credit spread to help manage their portfolio and to take advantage of selling premium as opposed to buying it. Right.
Yep. Yeah, and in regards to that too, Lex, a strategy I looked at and we've studied is, and for a while, it's, you hear the name, but you hear naked put selling, and it brings investors a lot of nervousness, which is, understandable because you do open yourself up to unlimited risk. But then when you compare it to something like buying outright stock, it actually has a very similar risk profile. And especially if you secure that with cash, so you have the margin or the cash up front to buy that if your put option is exercised, it's actually not as risky as just owning outright stock. And that's a way to kind of take advantage of this premium as well.
Right. Yeah, I like that. That's good. Okay, this looks great. Do you do studies in individual stocks too? I know you don't have that for today, but do you do it in like Apple, for instance, these same kind of things?
Actually, I do have something for you today,
Oh,
Lex, regarding individual stocks. Let me bring it up for you.
Okay. So, I hope it's my favorite stock. It could be one of my favorite.
Tell me what your favorite.
It could be one of my favorite companies.
Would it happen to be Tesla?
Oh, I love Tesla. I have a Tesla. I got to be honest. Full disclosure, I have one of these crazy things. It's so much fun to drive. And you didn't know that when you created this graph. I know that.
So this is the implied volatility surface for Tesla, and I'm going to talk about an implied volatility surface for SPX a little bit after this. But this is something very famous in the option world. We call it the volatility smile. And what we have on the X axis here is delta. And delta is, another way of expressing moneyness. It's a rough approximation of the percent chance that an option will end in the money by expiration. Okay. And what we see on the bottom here is moneyness. This is call equivalent moneyness because I put calls and puts in the same graph, but they're pretty interchangeable there. Sure. But what we see here is 10 delta being very out of the money, and 90 delta being deep in the money, and 50 being at the money.
Okay.
And what this volatility smile tells us is that when we look at the relative pricing in volatility terms of out of the money put options versus out of the money call options, they're actually nearly very close to each other. So let's say we take a look at the 20 delta put here. So that would be this point over here.
Yep. So it's over. Yeah, I can draw. I don't know if you find your. Yeah. It's right around there, right?
Right around there. Yep. And then if we look at the 20 delta call vol, it's right on the same side rather, because it's call equivalent.
Yep.
Oh, sorry. I flipped it on you, Lex.
Oh, you did?
Yeah. So it should be right. It's on the same line.
Oh, I got it. I got it. Okay.
So what this tells us here is they're a little bit different, but there's a small little gap between them, and that'll occur in single name stocks when you have projections about a borrow rate or a possibility of a dividend.
Mm-hmm.
But what that indicates to us is it's as expensive as buying a purchase of a call option is just as expensive as buying a put option on Tesla for 30 days. So playing upside risk is the same, has the same premium cost or nearly close to the same premium cost as playing downside risk.
Okay, and so what we typically found is, tell me if this makes sense to you. I know it does, but I'm trying to make if it makes sense to me. So we combine calls and puts in that's not the right drawing tool. Let me try this. We combine calls and puts and made our skew look like this. So we talked about this yesterday, right?
Right. Mm-hmm.
So our skew looked like this. Again, same 50 delta, but when we look down here, it was a 10 or it was a 20 delta put that we computed. And when we looked up here, it was a 20 delta call we computed. Okay, does that make sense? Because what we found was that the in the money options, they were wide markets. Sometimes they were parity down there or whatever, and they were marked around parity. We got better volatility values of the out of the money put and the out of the money call, if that makes any sense.
Yeah, I agree exactly. So that again, two ways of visualizing it. So what you'll see, a lot of the traders used a single surface, constructed from call and put vols, and one was using the OTM space for put vols and the OTM space for calls. We break it out to two surfaces in OptionMetrics, because you do actually get slight differences, like I mentioned, in borrow rates, and there's also an American feature in these options, which can actually drive the volatilities away from their fundamental European prices.
Right. Right. Okay. So then the top line, just so I understand, this is the call skew, right? Or volatility, yes. I should say. And so is that a 20 delta call or is that an 80 delta call?
That would be a 20 delta call.
Okay. And then what is this for the put? Is that a 20 delta put or is that the other way?
That is also a 20 delta put. Okay. So yeah, so they're expressed on the same axis. What we did was just took the 100 minus put delta. I got it. So now we can look at them on the, so this is like the absolute value, I guess you could say.
Right, right. Yeah, so we had, this is like a pretty good smile, I'd say, right? And we used to see, skewness, high downside put higher than upside call, similar delta, right? That's what we tended to see until, we had GME happen and we had this huge tech rally before it kind of sold off. Then all of a sudden, the way we look at skew, it kind of rewrited itself so that it became a true smile as opposed to a skewed smile, if that makes sense.
Yeah, absolutely. And, this is at one point in time. This is July 8th, 2020. I had to go back and find, this smile in particular, because we've actually seen the Tesla skew flatten over the last few weeks, and that's due to the fact that the Tesla rally has not been as strong, and there's been less call buying and these tech names to kind of push that smile up. Right. So in this example, what we're seeing here though is the fact that the market is interpreting upside as pricing upside risk nearly as it's pricing the probability of downside risk.
Yeah, intuitively, it doesn't make sense, does it? I mean, just to me, I'm thinking Tesla is, it's split 5-for-1, and where's it trading now? Like 700 or something like that?
Yeah, I mean, and that's, that's kind of, to touch back on what we talked about before, why historically buying call options has not been a great trade. Right. So you're essentially overpaying for one variance risk, and this also you're overpaying for this upside option. And in the academic space, we love to call them lotto tickets. OTM short dated call options are you're putting, and they're high leverage, so you're putting a little bit of money into it, and you're praying. But
yeah, no, it definitely makes sense. And I kind of refer to them as that as well. The only way, what my experience has been, as I said, we were typically insurance sellers. We sold premium, but we tended to sell the premium around the at the money stuff. So we would end up being in a butterfly situation, not by design, but just by risk management. right? So we would end up having to buy
Right.
units to kind of stave off that one, and seems like 8-year binary event that could, blow you out of your account. So we tended to have long units or flat units, and then a lot of short premium in the middle. And we did this not knowing nearly the academics of what you know about it. We did it based on, a little bit on order flow. And we also did it, by design because of what you said, these options decay and we tend to make more money being short them. So
yeah. And if, I think the money really where it's at as option trading is being able to systematically sell these overpriced options, and to give you a little graph and to, draw a little part. It's being able to systematically sell this stuff in a risk managed kind of way. And you mentioned you do butterflies and condors, which is probably a little bit more difficult to manage for the retail side of things. But anybody that can set up a strategy and stick to it, not advocating that it's on Tesla necessarily, but
sure.
they're systematically selling OTM put options in a in a risk controlled way, and you have the potential to generate a lot of profit.
Sure. And if you're a believer in the underlying, like you said earlier, and you get assigned on that short put, well, you're going to take delivery of the stock, and quite frankly, they call it a wheel now. You can sell a call against that, right? So now you've got long stock, short call, a covered call situation. You can essentially generate a little income that way as well, especially if you believe in the stock. Obviously, that's a very important part. That you want to be long it. So yeah, this is good. The other, one of the questions, can some of this call skew flattening? And I guess what that they mean by that is, as opposed to my shift, it's kind of a smile as opposed to a smirk. Is that the question? Is that coming from more entrance into the retail space, and call buying is a lot cheaper than buying a $700 product? And I'm just using Tesla to fill out this question. Does that make sense? So people can afford to buy an out of the money call to take advantage of a gigantic up move, as opposed to buying the underlying outright.
Yeah, absolutely. And some of this smile comes into comes into play regarding the demand impact from retail traders and as well as institutions. But over last summer, when we saw a lot of retail buying, we saw these smiles become incredibly, smiley, I guess you could say. Right. Very, very, the calls became very, very expensive. And like you mentioned, it's much cheaper to buy an out of the money call than it is to own 100 shares of Tesla stock.
Right. Right.
But if we think about it in volatility terms, it's actually it's a very expensive kind of proposition buying these calls, because, the probability of them landing in the money is rather small.
Mm-hmm. Mm-hmm. Right. No, agreed. Okay. You have one more slide, I think?
I do.
Okay. Good. That was good. I like the Tesla version of that. We're starting to see that too, that what I continue to call that smile shape in technology names. So that's interesting.
Yeah, it's flattened out a little bit recently, but during times of when stocks are experiencing a lot of momentum and there's a lot of upward call pressure on it, you see the calls becoming relatively more expensive. Which sure. If we go all the way back to supply and demand, it kind of makes sense, right? If everyone wants to buy a call, the market maker, you guys, are going to charge more for it.
Mm-hmm. That's right. 30-day implied volatility. Okay. So you use a lot of 30-day stuff. Is that by design, or is that kind of it's kind of my honey zone option as well? Sort of the maybe 60 on the high end, but 30 to 60 day.
Yeah. I mean, it's so in terms of the retail space, what we see is a lot of retail traders prefer to be in the, less than 60-day zone. Longer dated stuff. And the reason that is longer dated maturities. The premium gets significantly larger as you're buying. Sure. You're basically buying more time to maturity. But this is kind of the standard for us, as we say, what's kind of the 30-day baseline, what's the 60-day baseline for volatility. And if you look at the VIX too, the VIX is based off 30-day options. So it's keep it simple with a calendar month.
Sure, makes sense. Okay, what is this now, Garrett? What are we looking at?
So this is the SPX 30-day implied volatility skew. So this is the SPX index, and right only up here I have only put options. So the graph is a little bit different in terms of the axes. But what we're looking at here is the 90 delta to 10 delta put range.
Okay.
And with the 10 delta being out of the money. So there's a little trick in the options space when you have an index option. The implied vols that are at the same strike for calls and puts should be very, very close to each other through what we call like an arbitrage relationship. Sure. So you could look at this graph, and if you did 100 minus, like we saw on the other one, sure, you would get a very similar call surface.
Okay, got it. So, okay, let me make sure I understand, because again, you guys look at it a little differently than I do. So this is a 90 delta put, and in my world, is that right?
Yep.
Okay, and that would be the 10 delta call in my world. So I'm looking at this in reverse of how I always knew it, but I get it. That makes sense, right?
Yeah. So it's just, it's, you flip it around a little bit. Ideally, I should have put both on here, but
oh, that's okay.
we're gonna roll with it. So yeah, to kind of highlight the point, we saw the smile in Tesla, but now we're seeing sort of a smirk. Okay. And what this tells us is that in the call space, if we're referring to that 90 delta, which is a 10 delta call, it is cheaper than what you'd see in the 10 delta put space. So out of the money put options on the index are systematically more expensive than out of the money call options.
Makes sense. So that's what I'm used to in terms of the way we look at skew, except we reverse it. That's all. You do it the mathematically correct way. We do it the trader way. We can't think that way.
Both work,
They both work. Okay, good. So question, do you provide intraday historical data?
No, we do not.
Yeah, you mentioned it pre-show that you guys are thinking about that, but I know that's expensive. But you don't do that yet, right?
Yeah, so we're primarily focused on our end of day products and building analytics off of that end of day product. So useful tools for institutions and investors. That's our main focus now. I'm not gonna, I'm not gonna, what's the word? Prohibit us from going. I'm not gonna put a cap on how far we can go though as a company.
Sure. No, but you started, safe to say you started on the institutional side. And I think, what I started here too, on the prop side, I call it, or, we weren't institutional, we were market makers. And now I've totally morphed into the retail side. Right. And what I'm learning from all the conversations I have with all the retail folks who do demos with us and who want demos, they like these tools. They want to understand implied volatility. I think the thought is that it can enhance their understanding of trading and position management, right? The last thing you want to do is say, oh, I'll sell you, hurricane insurance, and the hurricane's right there about to hit your house for $10. That doesn't make sense. But if you pay me $10 million, I might consider selling you the insurance. So that analogy is, I've got to understand where implied volatility is in the whole scheme of the implied volatility, orb that my product lies in, right? And it's okay to sell high volatility. Sometimes it could be okay to sell low volatility, but you really have to understand it, I think. And I still get a lot of questions, about implied volatility as it relates to historical. So yeah, any thoughts around all that? That was a mouthful.
Yeah, absolutely. In terms of, thinking about implied volatility, it depends on, what kind of stock you're looking at it and what kind of risk you're willing to take. A popular way to get like pure volatility exposure is sell a straddle, right? And whether, when you start selling straddles in a very high volatility environment, for example, profits can be large, but in another sense, you're also taking on more risk. So I think the key for someone that's just kind of dipping their toes into this and, is going to say, I want to be a volatility seller, I want to do this in a systematic way, is to, have a strategy and stick to it. And understand that, when you experience a drawdown, it's going to be only temporary, and you've tested this and you kind of know that, my portfolio is going to recover. I have faith in it. But I have faith in my strategy. But regarding volatility selling, it's it's a more profitable endeavor for sure. It's more risky, but that's the nature of the beast.
Sure. What any common question you get from some of your customers about volatility in the surface and the skew? Is there something that kind of pops up regularly that you're fielding?
Yeah, there's a lot of, in terms of like technical questions, there's a lot about how we construct the surface. We like to keep that as our trade secrets, but
Sure.
some of the questions refer to, like, we have the volatility skew up in here. Can the volatility skew for single name stocks predict negative earnings, for example? In what volatility environment is it most profitable to sell straddles is another one. So there's a lot of, we field a lot of different questions regarding the construction of our models, but also, what are the best types of implementable strategies?
Makes sense. Okay. Another question that just popped in. The market tends to change IV near the close by widening bid-ask spread. So, I know that game well. How do you adjust your research to reflect this? Is there some, if you're taking end of day data, is there some way you're taking a midpoint or something? How does that play out with your data harvest?
So all of our vols are calculated at, we actually use a 359 quote for our US product. So we avoid that kind of close price wide bid-ask spread. And then in terms of our vol calculations, they're all done at the midpoint. So for very liquid things, when you're looking at, a few cents, it's kind of spot on, and we avoid that, big wide gap at the end of the day.
Okay. That makes sense. Yeah. That was a pretty much when the markets went electronic, that was a very common thing that happened. We were down on the floor. You didn't have time to widen your markets. You hit a button and you say, okay, I don't want to get nailed at 359 or, in 40 seconds.
Yeah, it's good words for retail traders too. You don't want to be stuck trading in the last minute. That's for sure. So
yep, it can get a little dicey then for sure. What about another question? What any common misconceptions about volatility? Can you think of anything that you've come across? I'm trying to think off the top of my head as well.
Common misconceptions to be wary of that, and this is from my own personal research, is if you read the news in the morning, a lot of news sources will attribute an increase in the VIX to this or this, but a lot of it's just typical market gyrations. So when we look at the VIX as kind of a measure of aggregate, it's the fear index, right? That's what it's been trademarked as. But one thing I like to think of the VIX as just a kind of a gauge of how relatively expensive buying options is, and insuring buying insurance through options are. So one assumption I would kind of try and avoid when it comes to volatility is that assuming that buying options in a low volatility environment is profitable, and necessarily selling options in a high volatility environment is profitable too. So it can vary widely based on the underlying stock, and if there's any major earnings events or corporate news coming up. So I would definitely, when it comes to volatility, stay away from like absolute. When you hear an absolute like that, it's not it's not a good thing. So
right. No, agreed. Any sort of analysis across volatility terms? I mean, now I guess where I'm going is the calendar spread or the diagonal when we're selling a near month, buying a farther month. You guys do any sort of analysis with that sort of data?
Yeah, so I can tell you from my personal research, when you look at when you look at calendar spreads, and let's say you're short the front month, long the back month, it's I tend to look at what the exposure on the creeks is, and I think about that, whether am I exposed to, let's say, gamma, which is a measure of what we call like jump risk. So typically, when you're selling a short month option, you're short gamma, and by buying the longer term one, you're long vega, so which is volatility,
Mhm.
meaning that your very small movements in the underlying can change the value of that option pretty quickly on the front. So when looking at calendar spreads or any kind of calendar combination, I always like to think about what is the risk in terms of the Greeks. Am I exposed to gamma, or how exposed I am to vega? And basically, gamma is has an even greater loss profile than being, we talked about volatility being long
Mhm.
vega does, just because these short month options, they're packed with a lot of premium relative to how much time they have remaining to be in the money. So
Got it. Okay, that makes sense. The question is, do you deal with the term vol of vol? So I think there's a VVIX product now, newer. So the volatility of volatility, I guess, is what the question is. Any
yeah,
analysis on that?
absolutely. So I put up that chart before regarding looking at implied volatility versus historical volatility. And that's another way of thinking about how are traders pricing the vol of vol. And the vol of vol can also be called the variance risk premium.
Mhm.
So that's something we study, and we look at different volatility regimes. How much is the insurance for changes in vol being priced? What you'll typically see is that as volatility goes up, right, you'd expect vol of vol to become more expensive. So
Mhm. Okay. I get it. Okay, good. They've been talking about the vol of vol a lot lately for some reason. So maybe that's why the question came up.
yeah, I mean, it kind of, I think it's in the last few years in academic research, it's become very popular. But if we go all the way back to Black-Scholes, a Black-Scholes model, which is what most of our Greeks are priced off of,
Mhm.
it doesn't really account for a vol of vol, because the assumption is the underlying volatility is constant.
Right, right. Do you guys use your own model for other than Black-Scholes, or do you have a combination of things that you've built out, or not?
So we have a combination of models for European style. So index options are European. We use the Black-Scholes, which is pretty standard, even across. It's an old model, but it's still used. It's still used by all the major institutions
Sure.
and for their pricing. And if it's an American option, we use trees in order to account for the early exercise.
Okay, and that probably answers the question: how do you adjust for dividends in the formula? So I would be using the other model, right?
Yeah, exactly. So using the tree model, we pick a node, I guess, getting a little into the weeds here, but we figure out where the dividend's being paid. We drop the stock price across across those nodes to account for the change in the stock price for the dividend,
Yep.
and then we run through the trade.
Right. Good. 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 Okay. All right, Garrett. Good. I think we got it all, man. That was really interesting stuff. I really appreciate this, and I'm gonna push into the retail world, right? At least I'm gonna try.
Oh yeah, we're looking at it, Lex. We're looking at it. We're interested. We've got good tools. Our institution, the institutions we work with would stand by us, and
Mhm.
we'd like to bring some of these very quantitative methods and to the retail space.
So thanks, Garrett. That was awesome. Appreciate it. And
Thank you, Lex.
yep.